Good afternoon and welcome to Biztech Asian Midday Marketwatch. Our guest today is Vishnu, Head of Economics and Strategy out of Singapore at Mizuho Bank. Now, Vishnu, as always, great to have you on the show.
Always a pleasure to be here, Brian. Happy New Year. Hope the year started off very well.
Yes, it has. I think for a lot of people, it was kind of a slow start to the year, those who actually went back to the office. But I think today is the day everyone's back at work.
Yep, that's true. And to a very different landscape if you're in the financial market.
Absolutely. Except for the Japanese, though, Japanese stock markets are closed today. So they're taking a little bit of and so you work for a Japanese bank, Vishnu. What's the reason for the holiday today?
That's a good question. You got me there. I'll have to pass on that, sir.
But I put you in a spot. So before we
in my defense, I will observe the holiday. So as you can see, I'm working. So here's my excuse for my ignorance 201, but excuse nonetheless.
So before we get your sagely advice, let's take a look at how crypto markets are performing. And then after that, take a look at regional stock markets. Now, we've got Bitcoin at 42,106.3. It's up marginally 0.03%. Ethereum is at 3,172.21. It's up 0.96%. As we mentioned earlier, Japanese markets are closed today, but we start with the SGX, which has the Straits Times Index is at 3,229.07. It's up 0.74%. Now, if you look across the region, we've got the KLCI, which is at 1,545.66. It's up 0.17%. Shanghai is at 3,586.22. It's up 0.18%. The ASX All Ordinaries is at 7,765.5. It's down 0.11%. The Nikkei is, of course, closed. The Hang Seng is at 23,676.5. It's up 0.78%. Rounding up the numbers, we've got the Kospi, which is at 2,928.08. It's down 0.97%. So Vishnu, very mixed markets. Tell us why.
Well, it does appear that markets are just trying to digest the whole mix of information, and I think the epicenter of this started last week after the FOMC minutes. And here's the thing. The FOMC minutes were supposed to be a stale, dated communique that's not supposed to do anything. However, because it unleashed the potential for quantitative tightening, so it's not just reducing bond buying and halting it, but it's really actively reducing liquidity in the markets. And we know equity markets are married to liquidity. And that started off a lot of rethinking, repositioning, because that was a hawkish jolt. So we've seen much higher US Treasury yields. We've also seen equities taking a bit of a knockback. And against that, we've seen a lot of data coming in. So there's some encouraging data about the recovery being on track. The US jobs recovery, even though the headline wasn't fantastic, revealed beneath the hood. You could see that the employment was strong, even if quit rates were rising.
Absolutely. So jobless rate was just running at 3.9%.
Absolutely. So your unemployment rate is low despite the job creation number disappointing or underwhelming if someone was only watching the NFP headline.
And Vishnu also at 3.9%, and you know better than this. This is below the US full employment rate of unemployment.
Well, I think that's where it becomes very difficult for the Fed to judge, because on one hand, you're absolutely right. I think the Fed usually uses about 4% as a gauge of full employment, but we are in a state of flux. We're in a state of flux where we've got huge quit rates, whether it's due to lifestyle reasons, the great resignation, mismatches, or hot job market that needs certain areas of jobs very, very highly contested, or it's just due to the border closures, keeping labor very restrained in terms of labor mobility between countries. There's a plethora of reasons here, and here's the predicament for the Fed. When inflation is running high, when they see that they're low unemployment number, they need to react to it from a policy stance with some tightening. However, I don't think within their own ranks in the closed door discussions, they're convinced that this is indeed durable full employment.
Okay, now Vishnu, I think to look ahead, we often have to look at the past. And I want to take us back in time to 2013, when the Fed triggered the taper tantrum, when it started to wind down its asset purchase program. Investors panicked, triggered a sell-off in bonds, caused Treasury yields rise. See, this movie looks kind of familiar. And as a result, emerging markets in Asia suffered sharp capital outflows and currency depreciations. And that forced, obviously, central banks in the region to hike interest rates to protect the capital accounts. What's your view on how you see this movie playing out this time?
Here's the interesting thing. I mean, initially we were all quite apprehensive about the Fed starting taper because we did, as you rightly recall, remember that the 2013 episode wasn't all that comfortable as understatements go. This time, however, taper seems to have been absorbed by the markets, so they just took it in step. And they said, okay, that's fine, we keep walking. Part of that reason could have been because this time taper is coming at a time when US inflation is very high, which means as an extension, it means that the real returns in US are pretty low. So even with taper, there is a case to be made that as long as global liquidity is maintained, EM Asia and the other EMs offer quite good real returns, adjusted for inflation, that is. Because in this case, we've got a very odd situation where US inflation is higher than inflation in Asia. That's typically not the case. This time, that has been circumvented. So in terms of taper, it didn't seem to have upset anything in the markets initially. But now we are confronted with a new installment, maybe a new movie set, where the tricky thing here is the transition from taper to rate hikes to quantitative tightening could potentially all happen within a year. Whereas if you look at the 2014 taper lift off, I mean the taper start, 2013 they warned about it, they actually started doing it in 2014. In that time, it actually spanned across 3 years. Between 2014 taper, you only started hiking rates in 2015, and then quantitative tightening, that's to say the reduction of the balance sheet, only started in 2017. So that gave markets a lot of breathing room in between. This time around, it's not a double, it's a triple whammy if all of this happens in 2022. And we haven't tested the shock absorber of this market, and particularly given that maintaining liquidity is one of the shock absorbers. So that's what renders the uncertainty around this, and perhaps explains why the year started off being quite roiled. And just to quote something that Yellen said before, so the first round of quantitative tightening we saw, Janet Yellen made this comment that it will be very gradual, it'll be like watching paint dry. This time around, depending on what happens, it could be painting the town red. So we really don't know.
Now, before we leave, Vishnu, what are you looking for in the week ahead that could move markets?
Well, I mean, the week ahead is fairly quiet. We've seen the FOMC minutes still being digested, so on and so forth. So we may see some sentiments data that come out following the Fed's, the non-farm payroll numbers in the US. In Asia, we want to see so typically when the PBOC is slated to make a move in the market, it's not a big deal, but we want to see what they do with their medium-term lending rates, given that the PBOC is diametrically opposed to the Fed in terms of easing policy. In the region, Bank of Korea comes up because Bank of Korea is going to make a policy decision. They hiked rates twice last year in surprise moves in August and November. Whether they follow up with a January move, I think remains to be seen. But if they do, then indeed, I think both BOK and the Fed are jiving to the same tune, which is Kokomo. Hit that fast, and perhaps, fingers crossed, they take it slow after that.
Now, Vishnu, one more thing that's coming out is a US consumer price report on Wednesday. Is that something that you're looking out for in terms of indication of how movement's going to be in inflation?
I mean, that's a good question, and I think that was conspicuous by absence in my telling you what we're looking out for. The one reason why we are giving that, or we will probably be discounting that, is we don't think that's going to change the Fed outcomes. If inflation comes in slightly softer, it's still going to be a really high bar. I mean, even if it comes in substantially softer, the argument would be the Fed needs to see whether this is durable or whether inflation pops back higher, given the backdrop of price pressures. If it does come in a lot higher, it's still not going to deviate much from the fact that March is a so-called live meeting. Taper is going to end, and the likelihood of rate hikes have already started increasing, so that may go up slightly more. The real question for us has got less to do with the reactionary impulses of the Fed to inflation, and more in terms of their policy strategy. And we want to see whether Fed Chair Jerome Powell comes into the picture to push back against expectations that quantitative tightening, that's to say the Fed's balance sheet reduction, could happen as early as this year or early next year.
Vishnu, as always, thank you very much for taking your time to be on the show.
My pleasure.
Now, we've been speaking to Vishnu Varadan, Head of Economics and Strategy at Mizuho Bank, on Biztech's Asian Midday Marketwatch. I'm Brian Fernandez. Please check out this video and podcast on our various platforms, as well as our website, www.biztech.asia. Please like and subscribe to our various platforms. Thanks a lot for tuning in.